Hey, yo, good evening, viewers of the tube. I'm your host, Tyler, and welcome to your favorite daily crypto channel. And if we aren't your favorite, let me do a little bit of convincing because it's time for Chico Crypto. Well, it has been a painful past week in the markets. Bitcoin peaking over 13K last week on Wednesday before stair-stepping its way down each day. And then on Sunday, another massive sell-off took place, getting the price below 10K for a short amount of time, but has since rebounded to over 10,500 as of yesterday. That sell-off triggered a massive amount of liquidations on BitMEX, over $164 million in total. The mass sell-off and resulting liquidations was the work of some market manipulations. A whale or trader group didn't use Bitcoin to get the sell-off started, but used Ethereum. They put in a mass market sell of 15,000 Ethereum on Bitstamp, which plunged the price immediately from $270 to $190, a flash crash. Now, these flash crashes on Bitstamp are a common thing, and they have happened many times since the launch of the BitMEX futures exchange. Why? Because the price data for the contracts is pulled from just a few exchanges, Bitstamp, Kraken, and Coinbase Pro. These exchanges are exchanges with lower levels of liquidity. For example, if we check out the Ethereum volume on Bitstamp for yesterday, it was just over 23 million. That dump of 15,000 Ethereum was over $3.5 million, or 15% of the total daily volume in one trade. This type of flash crash could not have been pulled off on a more liquid exchange. Like a disease, the sell-off spread into the BitMEX Ethereum futures contracts, which base their price 33% on the Bitstamp exchange. And many contracts were liquidated in the blink of an eye. The contagion spread into Bitcoin and the entire crypto markets, resulting in the dump we saw on Sunday. So BitMEX has a major problem. They are one of the most liquid crypto exchanges in the industry, even doing more volume than Binance. Yet they calculate their contract prices on exchanges that have way less liquidity than them. Does this make any sense? The only sense it makes is so market manipulation can take place. Even the Bitstamp exchange is getting sick of it and launching an investigation, because in mid-May of this year, a similar thing happened when a Bitcoin flash crash happened, when a whale or trader group dumped 5,000 Bitcoin at $6,200, over $2,000 below the going rate. This resulted in over $300 million in longs getting liquidated on BitMEX in 24 hours. Who the orchestrator is of these flash crashes is debatable, but since the majority of the action feeds into BitMEX, many accuse the exchange of initiating the crashes on Bitstamp to profit on their own exchange. In April of 2018, it was found out that BitMEX does trade on its own exchange, which if we scroll down in the article, we find out it's for profit and run by Nick Andrianov, former Deutsche Bank equity flow and exotics option trader. Now here's what freaks me out. People were a little upset when this news came out that BitMEX was trading on its own exchange. So a guy put up a Medium article uncovering some shady details called BitMEX Insiders Caught in Web of Lies. He put up a post of Nick's LinkedIn profile with his BitMEX position, and as we can see, there was a picture of him then. If we check out his LinkedIn profile today, the image is gone. Not a super good sign when photos start to disappear. So I wish there was some rock hard proof to say this was the work of BitMEX, but there isn't that rock solid evidence. But the words of Arthur Hayes in a Bloomberg interview do the talking. We missed out on the peak of finance. Instead, we got the decline. There's not as much money. It's boring. Bitcoin reminds us of what it would have been like trading an asset class in the late 80s and 90s. The 80s and 90s were rife with stock market manipulation. I mean, Bitstamp is a casino, placing leverage bets. If you had the power to see the cards and influence the outcome of the bets, could you resist if there were no repercussions? Personally, I don't think so. With the manipulation going on, whether it be BitMEX, Tether, or Bitfinex, it all comes down to centralized exchanges. Yesterday, there was a post on the top of the Bitcoin subreddit, which I really freaking like. It was titled, "You bought Bitcoin and want the price to go up? Own your private keys." They give examples of how Quadriga CX and Mt. Gox were proven to be operating with fractional reserve, and it's very likely most exchanges are operating in the same way today. If customers demand their Bitcoin from the exchanges, they will need to buy more to operate or otherwise collapse from the pressure. I know some of you are traders and keep your coins on exchanges, but if you're a subscriber or fan of this channel, I call for you to take your crypto off centralized exchanges, please. I know the few of us who actually do it won't make a big difference, but hey, at least it's a step in the right direction. And I'm going to continue to urge my followers to keep this up until the next Proof of Keys event, which happens in 170 days. What I'd like to finish today's show off with is a blog post from Vitalik in which Bitcoin Cash would be used for a short-term data availability layer for Ethereum. Basically using the empty Bitcoin Cash blockchain as a data storage and transfer second layer due to the large block size, high data throughput, and low fees. Now, I don't know why Vitalik brought this up, out of pure spite for Bitcoin or because he is actually considering it as a short-term solution in preparation for Ethereum 2.0. But you would have to think he is smart enough to know that the Bitcoin Cash chain could be easily attacked, as Bitcoin controls 95.8% of the total Bitcoin hashing power. Bitcoin Cash has 3.4% and Bitcoin SV has 0.8%. It would take just one small Bitcoin pool to obliterate and completely take over the Bitcoin Cash chain. Then in May of this year, the centralized aspect of the Bitcoin Cash chain showed its face. To thwart out a miner attempting to claim Bitcoin Cash from SegWit addresses during a chain upgrade, two Bitcoin Cash pools, BTC.top and BTC.com, thwarted the miner's plan as they used their superior hashing power to create the longest chain and thus give those Bitcoin Cash from the SegWit addresses to their respective owners. Morally, this was the right thing to do as the hacker was attempting to steal, but it shows how centralized the chain is as two pools colluded together to effectively perform a 51% attack. Using Bitcoin Cash as a second layer for Ethereum wouldn't be the brightest idea in my opinion, unless something could be done to raise the hashing power and further decentralize control over the network, which, from the looks of things, isn't going to happen anytime soon. Cheers, viewers. I'll see you next time.